What's going on, guys? Thank you for tuning into this episode of Twin Finance. My name is Dylan, and today we're going to be talking about the best investment strategy for beginners in a market recession. Now, I know if you guys maybe have heard in school or in beginner investment books, like you should just go into bonds and try and time the market. I'm not saying that's not a good approach. Sure, if you can get lucky and time the market, that's probably a good idea. But that's rarely going to happen, especially as a beginner. If you haven't witnessed a lot of economic turmoil and market crashes, then you're probably not going to know how to time a market efficiently. So basically what I've done is I've taken one of the most common investing beginner strategies. I'm just going to explain it to you and how it can benefit you in a market recession. So I know you guys probably know who Warren Buffett is. I'm sure everyone that's investing knows who Warren Buffett is. If you guys watch any videos on Warren Buffett and Jack Bogle and how he feels about him, he talks about Vanguard index funds and index funds in general, and why they're low cost, and we have a video on the channel that talks about them. But my opinion, guys, is we take this strategy of dollar cost averaging into an index fund, and we continue that throughout. So if this is your first month in the market, my assumptions in this video are this is probably your first year in the market, or for a year or so. You're younger, most likely, and you don't have a lot of investment knowledge, and that's okay. So what we can do, guys, is take this $200 a month right here. Let's say you're doing $200 a month into an index fund. Not a ton of money, but hey, for you, it may be a lot of money, and that's okay. But $200 a month into an index fund, and let's just say right here, this is month 0. So let's say January. Let's say this is the market index. This is just an example, guys. It's not actual real life evidence. This is just an example. So let's say the market peaked right here, and you bought your first $200 in at the highest point in the market in the next like 6 months, right, guys? Actually, 6 months right here. So this is the highest point. So you're probably like, geez, we bought it right at the height. So we bought in $200 right here at the highest point in the market before the market crashed. Now, that might not be that ideal because you're just going to see that $200 go down. So let's just say the market dropped. Just to make this real easy, it's not going to be a typical market chart. This is just going to be broad. It dropped to $9 right here after month 1. You put in another $200. So what that actually did is it puts your buy price right in the middle here, $9.5. So now that you have a $9.5 average price of the market index, throughout the market crash, you're gonna want to continue lowering. So let's just say the market, kind of hikes up and then drops another, let's say 10% down to $8. So what we did is we bought in another $200 at $8. So that lowers our buy price right down to $9. So we have a $9 buy price now, and the market's currently at $8. So we continue to lower it. Now let's just say the market continues to fall a little bit more, and we see, kind of just a bit of resistance. $200 again, month 3, right at $7. And what that does is that lowers our buy price even more to right around $8.50. So we got it right around $8.50, and let's just say the market starts to plateau a bit, because usually that's what happens at the end before it starts to rifle up. I mean, in 2008 that wasn't really the case, but usually that's what's going to happen in a typical bear market. So let's just say it lowers to $6. Now we bought in $200 at $6. Now we've lowered that buy price right down to right around probably closer to $8, if not a touch below. And let's just say our 5th month, and it went right back up to 6 something, and now our buy price is significantly below $8. Now, I know the most ideal scenario that everyone shows you is, hey, if you put that $1,200 in all right here at the last month, you'd be a rock star in the future, because your buy price would be closer to $6, which is significantly better than right above our $7 buy price in this example. But however, did you know that it was going to bottom at $6? No. And no one's really a pro at timing the markets, guys. It's so much human emotion involved. It's really hard to time. So especially if you're a beginner investor, this is the way you're gonna want to go about it, guys, and just stay loyal to that monthly contribution, Excuse me. Because let's just say our buy price is $7.50. And 2 years down the road, we got the market at $15. Well, now you're up 100%, and now that's a big gain. Now you would be up even more if you put all that $1,200 in at $6, but like I said before, how do you know? What if you put in all your $1,200 and you thought this was the bottom, but it ended up even further? Or you put it in, let's say you put in lump sums instead, and you put in more here and then more here, and you bought on the peaks, guys. Now it's going to be even less. Now the best way is just to not even try and time the market at all, guys. Just stay true to your monthly contribution and have faith that the market will grow over time. And I don't know about you guys, but I really believe that's going to continue happening. I'm sure if you guys watch Warren Buffett, he believes this as well. I believe this is the best way. If you're in the US or Canada, I know index funds aren't offered all the way across the world yet. But yeah, this is definitely going to be, you as a beginner, this is going to be, first of all, the easiest way. And second of all, the best way, I feel, for a beginner. Because I don't want any beginners coming in and just getting hammered. They picked that stock and boom, down 60, 70, 80% in a market crash because they went on and they picked it's a hot stock, like Micron at the peak, and it crashed to freaking half or less than half its value. So I don't want that to be people's first experience in investing. The main reason why is because when that happens, they get scared. They probably never invest again. And that's probably the worst thing you can do for your future, especially if you're looking to build wealth long term. So I hope you guys took some value from this video. If you have any comments or concerns, please let me know. And remember to subscribe to the channel. Take care, guys.